Well, we just got a crap load of earnings, and unfortunately, pretty much all of them were worse than expected. We got Apple, we got Google, we got Ford, which plummeted the most, we got Qualcom, we got Starbucks, we got Amazon, and we've got some problems to talk about. First, Starbucks is one where obviously we would expect that revenues in China would be the weakest, and indeed, the Starbucks revenues were the worst in China. Now, I personally think, and this is my way of trying to get exposure to China, and I have not invested in Starbucks yet personally, but I do think that there could be a potential to invest in Starbucks because they have substantially increased the number of store exposure they have in China relative to 2019. I feel like during the pandemic, Starbucks basically just flew to China and opened as many Starbucks as they could while everyone was on lockdown. Now that's really interesting because you would not expect to see any of that revenue really yet in Q4 since they basically just started unlocking the economy at the end of Q4. So I wouldn't be surprised to actually start seeing Starbucks revenues come in substantially higher in the future, led by China. Look, comp store sales in the United States are still kicking it. You're up, killing it. They're up 10% versus about the 9.2 that was expected. And the numbers actually did very, very well overall for the United States. But again, China comp sales were down negative 27% versus the 13.3% expected. US comp store sales beat, but net revenue in Starbucks because of China did miss slightly, coming in at just $8.7 billion. Now, I personally think Starbucks could be a play you want to pay attention to into the future, and they've already recovered off their bottoms, but I still think long-term there could be some really big growth and potentially pricing power at Starbucks. After all, who can sell you Starbucks for the price that Starbucks, or who can sell you coffee for what Starbucks sells it for? It's incredible. Obviously, a lot of coffee shops sell very overpriced coffee, but look at their margins, pay attention to the company. It's something to consider. I think that Chinese element is going to be ignored for quite a while, and all of a sudden Wall Street and markets are going to go, oh my gosh, where did all this come from? Oh, that's right, we forgot. Starbucks spent the entire basically pandemic just building stores in China. It's remarkable how many stores they've added in just the last few years here in Starbucks. So pay attention to that. You can see their exact store counts on their annual releases. Now, if you look at Amazon, Amazon did, they had a total increase in net sales. They beat on net sales, okay? We got 149.2 versus the 145 estimated. But when we actually looked at the details, because the devil is in the details, we saw some numbers that weren't actually that great. And this is a problem because Amazon, look, they're in a very expensive business. They're in a business of fulfilling goods and services. They're in a business of creating content for all of y'all, which I'll tell you, creating content for all of y'all is very, very difficult. Y'all don't like something, you out of here, okay? And Amazon feels the same thing on Amazon Prime, and it's very expensive. But anyway, take a look at some of these consolidated numbers here. You're on product sales down 1.2% year over year. Service sales down, whoops, lost it there for a second. There we go. Service sales down service sales up 19.2%. So you get sort of that blended increase in revenue, really pushed up by AWS, right? Services sales. AWS did grow, but it's unfortunately growing slower than it used to. If you look over here, at the beginning of the year, the AWS segment was growing at almost a 30% clip at 28.6%. Now it's only growing at 19.8%. That represents margin, and margin has compressed. So you've got growth slowing to under 20% in the server business, which is a higher margin business. But on top of that, you also saw margin compress. You had costs of goods sold of about 71.4% last year. Now costs of goods sold for servers have gone up to 75.6%. That leaves you with a 420 basis point compression in margin. So in other words, server and the profitable segment is slowing. Server growth is slowing, and operating expenses are widening. Not so ideal for Amazon, and that's leading Amazon to fall about 4% in after hours. We did have a technology and content boost of about 36%, G&A boost of about 32%, and another about $2.4 billion hit because of Rivian. Rivian, again, costing Amazon a lot of money. I personally maintain my belief that there's a high likelihood Bloomberg estimating 35%. Personally, I'm estimating a little higher likelihood of Rivian potentially going bankrupt. Now, a lot of people are like, but Kevin, Rivian's going to get bailed out by Amazon. Not necessarily. Just because Amazon's lost a lot of money on Rivian doesn't mean that if it's a bad idea to invest in Rivian, Amazon's actually going to choose to fulfill that bad idea and invest in Rivian. In other words, if the dog's gonna die, you kind of gotta give it its piece and let it pass away, okay? It doesn't mean you gotta keep throwing money at it, okay, to try to squeeze another week out of it. It's just, it starts getting inhumane at some point. Anyway, Ford also had disastrous numbers. The Ford numbers, not so great. Neither were the expected earnings, by the way, just to wrap up on Amazon. The Q1 expected actual net was somewhere between 0 to 3.7. The guide was like 3.9. So the fact that the midpoint is, basically closer to 0, not great. So a little bit disappointing there on the forecast. Ford, you had cost headwinds of an additional about $5 billion expected for 2023. They're calling car prices flattish with more incentives this year. Now, this reiterates what we saw with GM. General Motors told us the other day that, look, we think prices are good where they are, but we're going to give people a lot more discounts to buy our cars, which is basically doing a price cut without doing a price cut, right? All you're basically saying is we're going to keep the MSRP here and we're going to let dealers negotiate more. That's all they're basically saying. So in other words, prices are coming down. That's because, remember, Ford and GM, they still have the dealership model, so they keep prices stable and then they just discount more. At one point, Ford was down as much as 9% in the post-market, though it seems to be settling down by about 6% down. Their adjusted EBITDA is expected for their the next year to be sitting at 9 to 11 billion. The estimate was right about in line with that. They're paying an additional dividend of about 65 cents. And they've got adjusted free cash flow estimates of about $6 billion for next year. So you're still in a positive free cash flow territory for Ford. Qualcomm, not that great. They see weakness for the handset market. That's like cell phones, right? Like iPhones, sadly. Qualcomm's still doing a lot of the 5G chips for Apple, even though eventually Apple wants to bring this stuff in-house. They haven't fully transitioned away from Qualcomm yet. Qualcomm's still warning about potentially more weakness coming to the cell phone market. Initially, Qualcomm actually rose after bad earnings. This is because a lot of chip companies are suffering, and they've given such bad guidance that the fact that now we're getting Q4 earnings out of the way is kind of seen as a relief that some of the bad news is over. Their earnings per share came in at about $1.98, adjusted EPS $2.37. Their forecasts were kind of roughly in line with estimates. You had EPS guidance of about $1.53 to $1.73 for Qualcomm, and automotive revenue rising and an EPS beat in this quarter for Qualcomm. But I think what was more interesting was actually what was going on at Google. Now, Google, big boy, and then of course we'll get to Apple. So Google was another one where, well, the earnings just weren't as great as we were hoping for Google. We were hoping for some better numbers. Got okay numbers, but again, when you looked at sort of the devil of the details, they just weren't fantastic. Here is the devil of the details. Search revenues declined 1.6%. YouTube ads, a second quarter in a row of declines, unfortunately, down 7.8%. Probably not the best news for one of my favorite players, Trade Desk. You're seeing this shrinkage in advertising, whether it's in Google search down 1.6% or YouTube down 7.8%. Given that I'm also posting a lot of my videos on YouTube, probably also not the best thing, but oh well, it is what it is. Network revenue down about 9%. You're sitting at about an 18.2x PE ratio for Google right now going into 2023 for the year end. If you peg their growth at about 18%, you're looking at about paying about one peg. That's assuming they're going to get back to growth, which is generally expected for most of these companies within the next quarter or two. Google services actually down 18.5%. So some big hits over here. You do have Google Cloud, though, up 32%. So not bad for Google Cloud, but a little rough on some of these revenue numbers here. And their operating margin shrinking about 200 basis points. You've got plenty of cash at Google. So you don't really have any kind of capitalization issue. And when you look at cash flows for Google, you're still printing cash. You've got about over $15 billion of free cash flow in the quarter. You've got about $60 billion of free cash flow for the year. So you really have a company where, yes, revenue is shrinking. Yes, we've gone negative on revenue compared to those crazy comps from last year. But you've still got an insane amount of cash flow. You've got a phenomenal company here. I don't invest in Google right now, but it's something I would consider investing in, especially if we get a nice little treat of a dip. I'd probably be more inclined to bet on Google over Amazon because I personally believe the retail business of Amazon is going to be a giant anchor for Amazon into the future. I'm not a big fan of investing in companies with giant anchors. I'm a big fan of investing in companies with giant PP. That's pricing power, okay? I like giant PP. It's very good. It's very healthy. It's very important to have pricing power. But it's going to take a little bit of time to convince me that ads from Google have pricing power again. The nice thing with connected TV advertising from Trade Desk is it's a small and growing market in the advertising space, so it should be easier to beat. But these numbers aren't looking great for the setup potential for the next earnings report on Trade Desk. Now, the next one is Apple. Now, generally, Apple has substantial pricing power, but the problem with Apple is we had a miss. We had lots of misses, okay? We actually missed on, I'll give you the short scoop. We missed on wearables, we missed on Macs, we missed on iPhones. And we did beat on iPads, but unfortunately, that doesn't offset the decline in iPhones. Now, Tim Cook tells us that had it not been for supply chain disruptions, they would have actually been able to deliver more iPhones and show iPhone growth. But we didn't see that. Instead, what did we get? We got a decline in sales in China. We got a decline in sales in Japan, a decline in the rest of the APAC region. We got a decline in Europe, and we got a decline in Europe. In other words, sales declining as a comp purpose everywhere. And this was one of the first Apple declines since about 2016. Products declined 7.7%, products and services down 5.5%, on top of another 150 basis point squeeze on margin. Apple very excited, though, that they've got about 2 billion active devices right now, and they are hoping to get back to growth here in 2023, as many companies are. We're getting this over and over and over again at companies. They're like, second half, Kevin, focus on the second half, second half, second half, second half. Everybody wants to talk about the second half being a lot better, but so far it seems like we got to get the bad earnings out of the way from Q4 first. Now, there are two things that can happen here. We could see some of the euphoria of today relax, which is probably honestly a healthy thing, since quite frankly, let's be real, even a 3% decline, which we're seeing right now on Amazon or Starbucks or Apple, not a big deal relative to the price increases that we've just seen over the last few days. Apple, after all, was up 3.71% today. So even though Apple missed, you're literally just going back to yesterday's pricing. Like, who cares? Who cares? It's not that big of a deal. Google was up 7% today. Okay, it's down 3.75% in after hours. Who cares? $60 billion of free cash flow. The company's killing it with money. Yes, it is going to be difficult to compare it to 2021, and that's what Q4 does. So the goal is, how can you look forward, and which companies do you think are going to have the greatest pricing power going into the middle of 2023 when we finally expect to get some of these companies back to growth? While I don't invest in Starbucks, I'm very tempted to look at Starbucks a little closer for that potential Chinese exposure. I'm also curious to see how Apple's going to reposition themselves and how quickly we think some of those supply chain issues could go away. Because just because you have supply chain issues doesn't mean you don't have pricing power. It means people want your product, but you can't deliver. We'll have to pay attention to the earnings calls for details on that. What concerns me more for Amazon is that compression in the high margin business, which is the server business, right? Content generation, Amazon Prime is a loss leader, really, in my opinion. I don't think you're really making big money there yet. We could also see that in the numbers. We know Amazon's not making money on selling you goods and service or stuff at Amazon.com. That seems to be another money loser. So they're really trying to get AWS going as a cash cow, but so far they're cash flow negative. So I'm not the biggest fan of investing in cash flow negative companies, and Amazon is a big boy when it comes to negative cash flow. Unfortunately, consistently representing negative cash flow. You can actually see that on screen here. Q4 2022, negative cash flow, $11.5 billion. Last quarter, negative 19.6. The quarter before that, negative 23. The quarter before that, negative 18. So you kind of get the idea there, okay? We're not generating cash flow at Amazon. Whereas when you look at Google, you're looking at 91 minus 31. You're looking at about $60 billion for the year. This is incredible. But wait, if I add that together for 2022, oh my gosh, that's embarrassing. Hold on a sec. If I add together 18 plus 23 plus 19 plus 11 and add a couple there because I rounded a bit, you're about negative 70. Okay, as much as Google made in free cash flow, Amazon lost more of. That's insane. Like if Google took all of their free cash flow and gave it to Amazon in 2022, Amazon would have still managed to lose cash. That's insane. That's actually really insane. Now, if we look at the Apple cash flow, also look at that nice $30 billion of free cash flow. And that, folks, is just for the quarter of the fourth quarter. So Apple, massive free cash flow. Yes, you've got a little bit of a squeeze on margin and supply. So again, we've got to pay attention. What is that supply going to improve? Does Apple still have a big PP, a big set of pricing power or not? TBD. So these are things we're going to want to pay attention to. Ford expecting to see discounting. Not a surprise the stock is selling off on that news. Qualcomm's been one of those stocks that's been having a little bit of a rough time really coming up. I'm curious to see what we hear in the earnings call, though if it's anything like what we're seeing from Samsung, Taiwan Semiconductors, ASML, or really anyone in the chip sector, NVIDIA, AMD, it's probably second half of 2023 is when folks really expect chips to launch. So we'll see. It's an interesting set of earnings today, and hopefully you appreciated this breakdown on earnings. Make sure to check out the programs on Building Your Wealth down below. Learn all about big PP, big pricing power. You've got someone over here that says, I cringe every time he says PP. Well, I'm sorry. I keep talking about PP, okay? PP is very important to talk about. We have to build PP. You have to grow it. It's the most important thing you could do in investing. Hanes underwear for PP? Yeah, maybe. Anyway, big fan of pricing power. Big fan. Thank you so much for watching. Free cash flow, $45 billion annualized for Google. Doug, that's terrible. Oh, you what? Hold on. We got a hater. 40 billion. There's no annualizing. It's $40 billion of free cash flow. Yeah. Free cash flow for Google, $40 billion. I think you're being sarcastic. You're being facetious, aren't you? You're predicting forward. Oh, what you're doing is you're taking this quarter. Is that what you're doing? Let me see. Free cash flow. No, that's not right either. 23.6 minus 7.6, 16 times 4, 64 bill. A little more. Anyway, cheers, my friends. We'll see you in the next one. Goodbye, and I wish you a great PP.